Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, November 4th. A sustained drop in volatility is a necessity for getting sideline money back in the market on longer-lasting terms. Accordingly, one of the most encouraging things about Monday's session was how dull it was. After weeks of record volatility, boring is oh so attractive right now. The early indication today is that sideline money will be put to work, at least for the short term, as the major indices open nearly 2% higher. There hasn't been any corporate news to account for the strength. The earnings report from MasterCard was better than expected, yet the company emphasized a cost control approach to managing its business in a tough spending environment. Yahoo and Google, meanwhile, restructured the terms of their proposed paid search deal in a bid to aid its approval by regulators, but that isn't a market-moving matter either. Separately, Australia's central bank cut its key lending rate by a larger-than-expected 75 basis points. The aggressive move was another supportive reminder of the coordinated effort around the globe to improve the functioning of the financial system, and it has fueled the expectation that the ECB and Bank of England will follow with aggressive rate cuts of their own this week. The global easing of monetary policy and the continued improvement in term funding rates has helped mitigate the bearish bias that has dominated the trading action the last 2 months. Today, though, we'd argue that the early boost is being driven primarily by the understanding that today is Election Day. It's not a bid, though, rooted in the expectation that one candidate will prevail over the other. Rather, it's a bid rooted in the understanding that there will finally be clarity on the matter. The market will reassess the political implications tied to the victorious candidate and the composition of Congress in the days and weeks ahead. For the time being, though, there is a practical measure of relief that the campaigning is at an end. I'm Pat O'Hare for Briefing.com. Thanks for listening.